Welcome to a very special Indianomics. India's macros and markets have been flooded by a torrent of big changes, a substantial cut in personal income tax and indirect taxes, putting in about 1.5 trillion at least of rupees spending power into the hands of consumers, plus a 100 basis point cut in repo rates in the past few months, plus a 100 basis cut in cash reserve ratio due in a couple of weeks. But countering all this is one big bad news, the 50% tariff on Indian exports to the US, accompanied by, frequent acrimonious tweets by the US president. And to add to all this, we got a GDP number for Q1 that was way above estimates, making many people wonder why then so much stimulus. Well, to answer all these questions, I have with me my best, experts or expert teachers of the market. I have with me Neelkanth Mishra, the head of strategy at Axis Capital, and Ashish Gupta, who is the CIO at Axis Mutual Fund. Gentlemen, thank you very much for joining me. And first up, happy Teachers' Day. I can't tell you how much I learned from the both of you.
Thank you. You're very kind.
Neelkanth, to start, first this immediate boost. Do you think that this is enough to turn the wheels and push us to a better rate of growth?
I think so. I think so. I think the decline, so I'm not too worried about the US side and all the drama that they're doing. That's his style of negotiation, and frankly, by hyping it too much, they give it too much importance. I think the main reason the economy slowed over FY25 was not just the fiscal consolidation that was scheduled, but it was mostly because of the inadvertent monetary tightening. So if your credit growth goes from 16.3% in March 24 to 9.8% in May 25, that's a 6.5% point of slowdown. And given that the system is about 56% of GDP, banking system credit, we're talking about more than a 3% point drag in credit growth. Now, there is bidirectional causality, so slowing economy also drives this. That's a slower credit, but I think the catalyst here was the infamous LDR letters. Okay. I think the aftermath of the pegging USD INR at 83 and how it broke in the October-December quarter. So
many signs of tightness.
Yeah. So so now all of that is reversed. Now the problem with just easing monetary is that it's like pushing on a string. It takes time, and I was expecting that by November, December, some credit growth pickup will start happening, and that is absolutely critical for the economy to revive. I think what the GST changes do, while the primary objective I think is reform, it was not supposed to be a catalyst primarily, but it ends up being one. And so there is some destocking before 22nd September, but then when the restock happens, there are it's like billiard balls, so you have momentum going downward, then you have something hitting it the other way, and it starts to become, so what is a vicious cycle where the economy is weak,
become a virtuous.
Then quickly starts becoming a virtuous cycle, which is what we were into FY24. Some of it had to be tightened, but I think they ended up tightening too much. And so I'm quite confident that the measures taken so far are sufficient to lead to a growth revival. Whether they're sufficient to sustain growth over 10, 15 years, do we need more reforms or not? I'm sure you'll have questions on that.
Yes, I have. But before that, Ashish, the market thinks like this. The market is supposed to think forward.
Yes.
We have not seen that kind of a, positivity.
Sure.
So how would you explain the market's kind of placid reaction to what I would say are, very strong steps?
So I think the market has various facets to take care of, right? And there has been facets around what foreign investors have been doing. There's been the facet of so much equity supply, IPOs coming to the market. So the market reaction actually gets defined by multiple factors. And actually, if you see since the announcement of GST rate cut came, so that was nearly 15 days ago, actually many of the consumption stocks are up 20 to 30%. So when the final announcement came, it was not totally unexpected.
Yes.
Right?
If you look at August 18 and if you look at yesterday,
Yes, right. So there has been a big move.
level is the same.
Now, the market also has a memory of last 4-5 years where consumption has dragged for multiple reasons. Real wage growth has been poor, etc. So I think to really fully reflect this, market will not just wait for the impact of the stimulus, but how it translates into real demand, how it translates into corporate earnings. And as Neelkanth mentioned, we will probably not see that in the September quarter because of the destocking, but in the third quarter and the fourth quarter, there should actually be a sharp recovery. And I agree with him on both counts. You have
On the credit flow.
Yeah, the monetary stimulus takes about 6 to 9 months to kind of feed through, and on top of this, the stimulus that's come because of the GST rate cut.
Fair point, fair point. Now, before the market beats me up, they want to know from you what to buy. So I will have to ask you that directly. What would you bet on? Is consumption still worth betting on, Neelkanth? What would be the top 3-4 bets be?
Maybe on the discretionary side. See, remember that the fundamental drivers of the economy have not shifted. So you have a one-shot cut off.
Fundamental, I thought, has shifted. No, we were a capex concentrating fisc.
We are still that. So that is the message which I think is absolutely lazy thinking.
Okay.
That because see the objective of GST reform or the catalyst for GST reform was that compensation cess was ending this year.
Yes.
Constitutionally, it couldn't have been extended beyond FY26. Because of that, then you had some room to cut some rates. The group of ministers recommended cancelling 12%. And then the Honorable Prime Minister decided let's get rid of 28 as well.
So you don't believe you're going from capex to consumption?
0% probability of that, right? Because I think the priority remains to build infrastructure. It will all be, from the government side, it will be primarily supply side interventions.
Okay.
It's not going to be consumption boost. So, and remember that we are still in a stage where labor is in excess, capital is in shortage, and therefore the pricing power of labor is not changing. So beyond the 8-10% boost that comes from reduction in prices and growth in volume, I don't think there is anything more to be read from what is happening.
Okay.
So it will remain.
So to come to the sectors.
Yeah, so it will remain an investment-driven recovery. I would look at credit providers because when credit growth starts to pick up, it kind of feeds on itself. I would look at construction proxies. I would look at high-value discretionary items. So I would any day prefer cars over FMCG, for example, if I have to play the consumption theme. So yeah, so those would be my bets. I think on global exposure, I would continue to remain very worried. There are very negative, very bad signs that are now coming out. So, and what I fear is that when the Trump administration begins to understand that tariffs don't work, and I'm reasonably sure they won't work, they will start solving some of the other problems that they have to solve, like high debt to GDP, like an excessively strong dollar. And once they start doing the drama around that, we are headed for a very severe period of uncertainty. So fundamentally, I think global exposure is something that I would stay clear of. And the big change in the next 12 months is going to be a revival in credit growth, revival in discretionary demand, and revival in construction, etc.
Okay.
Those are the places.
Okay, that's very useful. Would you agree, Ashish, or would you want to add to some of the sectors? I mean,
so I think.
For instance, e-commerce, you can see a paradigm shift in the way people are consuming.
Yeah.
So UPI, any of the other ideas?
So I think what I'll want to add is that not just sectors, but you actually have to look at which are the companies, right, which are gaining market share, which have the products that are actually more desirable. So if you look at the math, right, you said the number that with the GST rate cut, maybe there's 1.5 lakh crores of more purchasing power, right? So total private financial consumption expenditure is about 20 odd lakh crores, right? So it's about 5-6% impetus, right? But this 5-6% excess volume growth, value growth will not go equally across all categories, across all companies, right? So clearly, incremental income is going into different kind of spending, right? And that's where I agree, sectors like auto, consumer discretionary, white goods, etc., will benefit, right? Health insurance is another sector. But even within that, there are companies that have products that are now more desirable. They are gaining market share, right? So whether people are going towards retailing or people are going towards quick commerce, right? So those spends will actually increase faster, right? And then you have the second order beneficiaries like the financiers, so banks, NBFCs. So if health insurance goes up, then hospitals also do better. You have wide.
So you're positive on health insurance and
Yes,
hospitals.
and hospitals. You have, for example, white goods doing well. So certain EMS companies who are actually manufacturing for them also benefit. So you have to look at direct as well as indirect beneficiaries.
Fair point. Now let me come to the economy again. We have seen GST reform. As you said, it was inevitable because compensation cess will end. And by the way, as that ends, that's another 1.2 trillion rupees available. So actually, the stimulus for spending is maybe more than 2 trillion. What is your sense in terms of the next gen reforms we should expect?
So, see, the government has so far, through its fiscal discipline, brought down the cost of capital for entrepreneurs. So, a AAA 10-year bond at 7%, AA at 7.2, cost of equity capital, courtesy folks like Ashish, is already quite low. And now I think the need is to improve ease of doing business. So all that, Team Lee's RegTech keeps putting out 65,000 regulations, so many filings, so many with criminal penalty.
Yes.
I think all of those need to be brought down because when you've created this and you have low corporate tax rates and you have, even in FY25, in the BSE 200, operating cash flows, investing cash flows are only 80% of operating cash flows. This was despite significant jump in acquisitions. So the larger firms, while it was initially frustrating to me that why aren't they taking more risk, history says that the incumbents generally try to protect their turf. They don't try to take risk. All the challengers will come from the small and mid caps and so the smaller firms, which will make use of this environment. To help them grow, I think deregulation has to be among the most important things. That seems to be the government priority as well. How quickly the state and the central governments can resolve that becomes very important. I also think that, and here I'm being more prescriptive, that I think simplification of government structure itself is required. Like there's no need to have so much, so many departments looking at like power and oil and gas and coal and new renewable energy. This energy.
Rural development.
Or think about the fact that there is convergence of technology, but we still have a Ministry of Information Broadcasting, Ministry of Telecom, Ministry of
all separately.
Yeah, so they're all doing it separately. In electric vehicles, traction is done by MHI, heavy industry. The subsidies are handled by Ministry of Road Transport. Electronics come from Ministry of Electronics. Batteries, yeah, so that I think is
your accent is that it will be more deregulation and simplification.
Simplification, because that's because the government role in the economy is actually shrunk. And the last point I must say is that I think unlocking some of the, again, I'm being prescriptive. I mean, one thing you learn by the government is that there is acceptance of ideas, but the pace at which it happens is determined by opportunities. So like the GST simplification, we've been pushing for at least 5 years. But it was when this opportunity came that suddenly things fell in place, right? So we have to keep pushing for it. So I think land, and especially so much of land that government entities hold, as we think about the next 15, 20 years of India's GDP, a large part of it will come from real estate construction, housing construction. And to bring down the costs of that, I think a lot of the land easing, regulatory easing will be required. So these would be, but that's more prescriptive at this stage.
Well, I have to take a break, but lots more questions lined up, especially earnings growth, GDP growth. How do we face tariffs? All those questions lined up after the break.